Today we're talking about something that has been growing louder across the markets, and that is fear. Not just in crypto, not just in equities, but across every major asset class, including the AI sector that has been leading this cycle. People are asking the same question over and over again. Is the AI bubble finally about to pop? But here's the twist. When markets reach this level of fear, when the crowd feels completely prepared for a crash, history tells us that reality often plays out very differently. So today I want to walk you through the narrative, the data, and the historical patterns that everyone needs to see. No hype, no fear mongering, just a clear look at what's really happening here, folks. My name is Paul Sampson. Welcome back to DataDash. Markets are tense, liquidity is uneven, tech valuations are stretched, and the AI sector, which has led the entire market rally, is now under scrutiny. We've got warnings about an AI bubble, comparing it to the dot-com era, saying that valuations are too high and that this entire trend is built on expectations instead of earnings. And at the same time, volatility is rising. Sentiment surveys are showing extreme fear across equities, crypto, small caps, and even bonds. And when fear becomes broad like this, the narrative becomes contagious. But here's the key. Fear alone does not cause bubbles to burst. Mispricing, leverage, and a lack of fundamentals do. And that takes us to the important distinction between today and the 1999-2001 dot-com era. During the dot-com bubble, companies were valued on just ideas. But today's AI cycle is being built on something completely different. Real revenue, real infrastructure investment, real adoption, and real competition. We have companies like Nvidia, Supermicro, AMD, Microsoft, and Amazon that are generating billions with a B in cash flow all around AI, and that is not theoretical, folks. And even if valuations are stretched, even if we see a correction, the underlying trend is not going away. AI is already being woven into every single industry: healthcare, finance, logistics, energy, robotics, marketing, transportation, you name it. So yes, some AI stocks will collapse. Some companies are going to fail. Some projects are going to evaporate. But the idea that the entire AI sector will implode the way the dot-com bubble did, when revenue, infrastructure, and use cases are exploding, is a misunderstanding of what's happening here. And right now, markets are pricing in a worst case scenario, a cooling macro environment, tighter liquidity, mixed earnings from some major AI names, as well as geopolitical pressure. But here's where things become very interesting. Whenever fear reaches this level, whenever investors believe a crash is not only possible but imminent, the probability of that crash actually happening drops dramatically. Now you may ask yourselves why. Because markets don't usually crash when everyone is ready for it. Markets crash when the crowd is overconfident, not when they're terrified. And right now, folks, fear is everywhere you look. You can see it in fund flows, you can see it in cash positions, you can see it in sentiment surveys. This is exactly the moment where disciplined investors get very interested, or at least pay close attention. So let's actually zoom out a bit here. History shows that the biggest trends in markets, whether it's tech, energy, commodities, crypto, or AI, almost always face a moment where the crowd believes the trend is over. During the internet boom, for example, people said Amazon is overvalued, Google will never monetize search, cloud computing is just a fad. We know how all that turned out. And fear did not kill those trends, folks. It actually strengthened them because it cleared excess speculation and rewarded the real builders at the time. And that's where we are with AI. Not in a euphoric phase, not in a mania, but in a shakeout. And not a traditional shakeout where we see the price come down and then the price just rips back to the upside, right? Where we actually shake people out of their positions. This is almost like a mental shakeout at this time. A period where the crowd is questioning the entire trend here, even though adoption is accelerating. One of the most interesting headlines recently was Warren Buffett's new AI adjacent investment. And Buffett does not typically buy hype. He doesn't chase trends. He buys quality cash flow and durable economic value. So seeing long-term value investors take new positions here in AI infrastructure during max fear, and also while the overall markets are just about at all-time highs, which is a very, very different place that we've seen in history, right? We're almost never in complete fear at the all-time highs here, but yet here we are as many of the main indices across the stock market and also major companies in the traditional finance world, such as Nvidia and others, are near or at their all-time highs here. Everyone is at extreme fear here, in fear that this AI bubble is about to pop on their head. And to see Buffett come in and actually making new positions here is a signal worth paying attention to, at least. This doesn't guarantee that we're at a local bottom here and going to shoot straight up from here, but it demonstrates something important here, that smart money is not viewing AI as a bubble that's about to pop potentially. They're viewing it as an early stage transformation with decades of runway. And personally, while I imagine that AI is going to continue to evolve and adapt and be integrated into everyday life over those next decades to come, even if we still have a sizable correction due to us, personally at least, and this again, I mean, we're at a place and a time where caution is definitely warranted. 2026 to 2029 has been a backbone target zone for myself, higher time frame in my analysis for when everything would see a potential high and we would get that next Great Depression 2.0 styled correction. It's just, are we still a few more years away, even if it's just one more year here in 2026, 2027? I just bring this all up because, folks, to see everybody so fearful right now and in agreement that, it just has to be now, it just feels, it's an odd, it just doesn't set well. And very rarely will the crowd get this right? Now, bubbles are only 100% obvious in hindsight, but there is a common pattern here. When the crowd is euphoric, generally that means that we are in a bit of danger, and when the crowd is terrified, that usually leads us to an opportunity. And right now, it seems like the crowd is almost terrified in advance, if that makes sense. But here's the thing, a crowded fear trade is rarely the right trade. Everyone expecting a collapse reduces the probabilities of a collapse, at least during that time, right? Because people already have reduced risk, raised cash, and repositioned. Now, crashes happen when portfolios are over-leveraged, over-invested, and unprepared. And right now, it's quite the opposite. The AI narrative is bigger than valuations. It's bigger than hype. It's bigger than quarterly earnings. AI is becoming an economic force, a productivity force, a deflationary force, a competitive force, as well as a geopolitical force. This doesn't mean that the sector moves in a straight line. We absolutely are going to see corrections, sharp, violent, and unpredictable as always. But those corrections don't end secular trends. They reset them and allow disciplined investors to participate. And over the next 12 months, I'm watching a few key things here. One is earnings durability, which means, are the AI leaders continuing to grow revenue? 2, are companies still investing billions into AI infrastructure? 3, the adoption metrics. Is real world usage still going to be growing? 4, valuation compression. Are we getting opportunities to buy quality at fair prices? And 5, macro liquidity. Are the conditions stabilizing or tightening further? And if these 5 things hold, any correction becomes a setup, not an ending. So yes, the markets are extremely fearful here. People are calling for the AI bubble to burst, and bearish sentiment is literally everywhere. And while I'm not advocating for everyone to just go and overly expose themselves now at all-time highs, because I am also in a camp where we are nearing that time and that period where prices and the markets are likely to see a sizable correction. It's just, for me, I still think it's potentially 1, 2, maybe 3 years away from us, right? It's also that time of caution here, but just don't be surprised if the markets still head higher from here, while everyone's expecting this next coming year, or currently where prices are today, to be the highs, and for everything to roll over, crash, and all that. I still think there's a little bit more time here, and that's what this message is truly about. Again, not spreading any type of fear, not spreading any type of hype, not saying go overexpose yourself today, not saying to sell out of everything today. I'm presenting information to the best of my knowledge, to what I'm using in my day-to-day, investing strategy personally, as well as presenting a different viewpoint that I think many are not really open to, or just don't see easily, right? So again, the bearish sentiment is everywhere, but historically, this is exactly when bigger, higher time frame, long-term opportunities begin to form. Now, not to be confused with, once again, trying to come in here brand new as far as all-time highs would go, but just to see that there are potential moves here still ahead of us. And now the crowd is rarely right at extremes, and right now we are absolutely at one of those extremes. But it's probably one of the most interesting ones to me, because again, we're not overly bearish at a bottom, and we're not overly euphoric at a high currently, because or a little bit of both. This is a very unique situation because currently we're pretty much at all-time highs. Crypto's a little bit of a caveat there, right? We've seen a pullback in crypto, but as far as the stock market goes, the traditional finance, we're relatively at the all-time highs, and there's almost zero interest as far as investors would go. It appears, at least, as far as sentiment would go. And then the going idea set here is that we are going to see this AI bubble pop and everything's going to crash and everyone wants to buy cheaper. And that just seems like a trade that isn't going to fare well, in my opinion, at least in today's atmosphere. At time of recording, December of 2025. I guess we can all see how that unfolds. Once again, not advocating for everyone to rush out and buy anything brand new today. That's not at all what I'm trying to say. More so, I just want to point out that we are at a position where there are major investors taking new positions. Basically isn't always an absolute up only indicator either, right? Nothing's perfect in this world, but just the fact that we're at a place where almost everyone is seems at least mentally prepared for the markets to kind of roll over. It just seems like it's just not going to happen that way. It's not going to be that easy. It's not going to be that simple, right? So just be prepared for that market turnaround, right? And just see just be aware that we could very well see new highs coming in as we go into the next year here. So if you found this breakdown helpful at all, be sure to hit the like, subscribe, and if you'd like deeper analysis, be sure to check out datadashpro.com for our free weekly newsletter, as well as Discord access and our monthly Dash report. I'll see you all in the next video. Thank you all so much for watching. Until then, everybody, cheers.